Dividend growth investing. What is this style of investing and how might it apply to you? Welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Okay, so tonight we're going to talk about dividend growth investing. Now I thought I might do a video on this because it's actually an alternative style of investing to the other two I've talked about on the channel before, which is growth and value investing. So what makes dividend investing different? Well, a lot of people think it is a safer way to invest, but it's also a lot less exciting and more long-term orientated. So a lot of people don't like to do this kind of style because it's quite boring. It requires a lot of consistent effort over many years. So how exactly does dividend growth investing work? Well, basically it's in the name. So we've talked about dividends before. Dividends are payments paid by companies to their shareholders as a reward for owning their shares. Now, each company that pays a dividend has what's called a dividend yield. So that's the percentage of your investment that you will get back every year. So if you invest $100 in a company that pays a 5% yield, that means for every $100 you invest, you'll get $5 back every year. Simple enough. So the idea of dividend growth investing is to invest money consistently over a long period of time into either dividend paying stocks or stocks that might pay a dividend into the future. So the idea is that if you do this over a long enough time, eventually you'll build up a very large stream of dividend income. Okay, so there are two real strategies when it comes to dividend growth investing. One is to buy companies that already pay a very healthy dividend. So that might be one of the big four banks in Australia or Telstra. And that way you're already getting quite a large yield on your money. So if I went out and bought Commonwealth Bank of Australia shares, I'll be getting between a 5 and a 6% yield. So that means that every $100 I invest in Commonwealth Bank, I'll be getting $6 back every year. So that doesn't sound like a lot, but if you do this over many years, put $100 a week, say, even into Commonwealth Bank shares, you can see that the shares will start paying you quite a large amount of money over those few years by the end of it. So that's one strategy that people have when it comes to dividend growth investing. And basically all people look at with this particular strategy with dividends is how sustainable is the company and therefore how sustainable is the dividend. Because the company can cut the dividend if their profits decrease because they actually can't afford to pay the money out. So if I was looking at a dividend paying company, I would look for a really solid, reliable business model. So Commonwealth Bank, for example, definitely has that. It's got millions of customers. Telstra has that as well. They've also got millions of customers and a very robust business model. The other strategy you can use with dividend investing is to look at which companies might start paying a dividend in the future. Because if you can get in early and get in when the company really just initially starts to pay the dividend, you'll actually make it into a very profitable investment. Because companies normally start when they start paying a dividend, they'll pay a really small yield and gradually increase it over time. So they might start with 1% and then increase it to 1.1% the next year and then 1.3% the year after and so on and so forth. So if you get in early, you can actually make a very healthy return on your investment over the long term. Warren Buffett did this with Coca-Cola. He started investing in Coca-Cola 30 or 40 years ago. And now he gets a 60% yield on his original investment because the stock has appreciated and Warren Buffett is still getting his original yield on his original investment. And that's grown into a 60% yield. So that's like saying if I put $100 in Coca-Cola, every year I'm getting $60 back. So you can see it's a very successful way of investing. Apple, for example, has only just in the last few years started to pay a dividend. Now, most people think because Apple is obviously a very successful company with a very solid business model that they will just keep increasing that dividend every single year. So if I buy $10,000 worth of Apple shares and they're paying a 2% yield, maybe in 3 or 5 years' time they'll be paying a 4% yield. But I got in early, so I'm getting a much better deal on that yield. And that brings me to my third point, passive income. So dividends are a form of passive income because you'll get that check in the mail no matter if you stay at home all day, go to work, it doesn't matter. That money is yours and it's coming to you regardless. So that's another reason why people love dividends is because it's passive income. Now, if you build up a stream of this, it can be quite lucrative. You might even one day be able to make half as much from dividends as you might from your job if you do it consistently over a long period of time. So that's why people really like dividend growth investing. And of course, if you do it consistently enough and put enough money in and do it early enough, you might even be able to retire early, because that dividend income can maybe even one day replace the income you get from your job. So if you do it consistently from, say, age 20 to age 40, maybe if you invest enough, you'll have a dividend stream that's so reliable you'll be able to retire early. The last thing I want to say about dividend growth investing is DRIPS. Now, DRIPS stands for Dividend Reinvestment Program, and that basically means that instead of getting the dividend paid out in cash, you can actually opt to use that dividend to buy more shares in the company. So obviously that's a really effective way to compound your wealth over a long period of time, because if you buy Commonwealth Bank shares again, and then instead of getting that 5% return, you choose to have that 5% yield reinvested back into Commonwealth Bank shares, the next year your dividend will be even bigger, because those new Commonwealth Bank shares are now paying you a dividend. So if you let this compound over many, many years, you can actually build a lot of wealth passively. So that's the final reason why people really like dividend paying shares and use them in a dividend growth portfolio. Okay guys, I hope you liked this video. Dividend growth investing really is quite a popular way to invest these days, but please do your own research if you're thinking about buying any stocks. Thanks so much for watching. I'll be back soon with some more videos, but for now, good night.